Okay, Randy here again. Hope everyone's doing well. Just want to discuss a little bit about what's going on in the housing market these days and want to lay out some things. First of all, I'm going to start to produce a series of videos that are discussing why we are moving into a housing bubble and future housing crisis in our real estate market right now. I would expect there will be a shift. Many economists that I read and follow are suggesting that we're going to have a market shift probably end of 2018 or early to mid 2019. We'll see some things plateau, and we'll start seeing some price, like I say, decreases over the next little while. We still have what I'm going to call the spring, I guess you could say, buying frenzy. Everybody knows that. Typically, this is the sort of busiest time when houses close. People are moving, kids are being relocated to new school districts, things like that. So we're probably going to see a little bit of an uptick just because of the seasonal volume that happens this time of the year and throughout the early summer, and then things will sort of slow down probably quite dramatically right after that. So that's kind of the prediction I'm looking at here personally. One of the things I want to talk about is there's many reasons out there that I believe we are moving into we're in a housing bubble and a housing crisis. If you check out other videos or publications, etc., many metro markets across the U.S. are already overvalued. Some markets are already starting to slide. There's slight decreases. Rental rates are up as well too. So if you can't buy a place, you're forced to rent, and of course the rents are up as well. So there's a lot of things going on, a lot of other factors that are going to contribute to what's going to happen in the future. But one of the things that I really am looking at is basically lending and loans. That's one of the reasons why we had the previous housing meltdown and issues, and we're kind of set up to have it again. So what I'm kind of looking to isolate here and show is the fact that what happened back 10 years ago plus is happening again. We have a number of things that are going on in the industry that mirror what happened over a decade ago, and we all know what happened there, which is interesting. We've seen the exponential growth, and we've seen the crash and the recovery. So we've seen kind of a full cycle here, yet we seem to be oblivious to what's happening right now. And if you go back to the whole bubble theory and concept of I spoke of earlier, fear of missing out, we're back in that frenzy now. People are trying to get properties, and not necessarily investment opportunities or investors. We're talking just retail buyers. They're jumping in because we have low inventory and prices are rising, and at the same time, you have interest rates that are rising, so their buying power is diminished. If you have a set dollar value for down payment, obviously, as a percentage of down payment for your property, that percentage is getting less and less as properties rise. Yeah, you may say that the lending has higher standards or better credit scores, but in the end, it's starting to loosen up. And I find it really interesting that on a couple of situations here, we look at that, subprime is back in the market. Subprime is now called non-prime. And a lot of the non-prime lenders have been very open, saying we're going to go after the market segment that is not being serviced, and we're going to overlook some of those things like bankruptcies and short sales and foreclosures, and maybe not really worry too much about student debt and things like that. So lenders want to lend, and they're basically trying to find ways to bring more people into the housing market. So it's just kind of a coincidence that subprime, and it literally subprime, from the first quarter 2018 compared to 2017's first quarter, more than doubled loan origination. So obviously it's a segment that needs to be serviced, and a lot of lenders are going after it. So that's kind of the one issue. We basically have subprime growing and growing very fast. It's called non-prime now. Clearly, as time goes on and properties rise, you have less, as I said, less down payment you're going to put on, less escrow you're going to put into the deal, which means your risk goes up and you're exposed. So I look at it going, if you're taking 3% loans or 5%, whatever the number is you're putting down, you really are exposing yourself for future problems. So if there is a market shift down 5-10%, you're now sort of stuck in your house. You can't actually sell the house, closing costs, commissions, whatever. The net result is going to be you're either bringing cash to the table, or you're going to be stuck or having to use some other method to get rid of your home. So that's kind of the situation here. So we're basically sort of setting up the same thing once again. Now, what's different this time though is I'm going to say the I'm going to call it the emergence of the non-bank lenders. Now, typically back in the day, we had Bank of America, Countrywide, Wells Fargo, Deutsche Bank, all these other banks that basically grew and originated a lot of mortgages, and in the end had issues. They got bailed out, and other banks assumed sort of the assets and the results of that. So there's been a lot of mortgages were transferred and assigned, etc. But the non-banks sort of don't fall into that sector. So what's kind of happened is, as the years have gone on, especially the past couple of years, the traditional banks, the banks that basically like your B of A's and Wells or whatever, they're actually lending less, and they're lending to their own client base, and they're keeping a good control on that. The emergence of what I call the non-bank sector, which are basically lenders that don't take deposits. That's how they're kind of qualified as a non-bank. They don't have traditional deposit accounts for their clients. They basically are just looking for mortgages and credit cards, and they're obtaining wholesale rates or credit vehicles from other banks to lend the money, and they're kind of exposed. So one of the main issues is we call the non-bank liquidity. Now, these non-banks are not protected by the government. So, and which means they're not going to have FDIC guarantees, and they're not going to be bailed out. That's the situation. So if something happens, it's going to be a big loss for the banks, and eventually there's a Ginnie Mae does some of this backing, I believe, but it basically is they're the last ones to come to the table, from what I understand. I think I need to be corrected on that, but either way, it's not the same as a traditional bank. But that is the most growing segment. So I was looking at a report that came out the other day, produced by Atom Data Solutions, and it boils down to when you take a look at the first quarter 2018, largest mortgage lenders by originations in the first quarter of 2018. These non-banks are being referred to as shadow banks by some of the economists and analysts out there, which is interesting. And for out of the top 10, the positions number 1, 4, 5, 7, 8, and 9 are, that's the top 10 originating banks, are held by the non-banks. So if you think about that, that's basically 60% of the top 10 are non-banks. And then the first is Quicken Loans. So obviously you see the Quicken Loan ads and Rocket Mortgage and things like that. So basically, these are applications, these are call centers you can call into, and you can get your loans done quicker, and maybe there's a little easier origination process here. But a lot of these banks are becoming the originators of home loans now. And if they start offering, lower rates, or sorry, not lower rates, but lower expectations, lower down payments, and more subprime type, I guess you could say programs, that just fuels the fire. So I think this is, yes, when you hear that banks and lending is controlled a lot better, they are from the larger banks. Certainly that is the case, but this reemergence of another sector that doesn't have protection from the government, that can't be bailed out, is kind of worrisome. And this segment's only going to grow as the year goes on, as time goes on. So that's kind of my point here, is that you got to take a look at lending. And what happened last time was subprime was the first sector to kind of crumble and fall and started the whole process. Subprime loans as a whole through the last housing crisis, they were not the majority. They were roughly 20-25% of all the loans that fell apart. There's other reasons why lending can cause problems. Cash out refis, taking home equity lines of credit, otherwise known as HELOCs. Also, I mean, that's going on right now. The past few years, there's been a big resurgence into HELOCs. If you actually take a look at what I call the underwater mortgages, I guess you could say the other month we actually had the lowest decrease in underwater mortgages. So obviously, back in the day, as the housing crisis hit, we had something like 14 million mortgages that were severely underwater, which basically means you cannot, your mortgage is worth more than your home on the appraised market. All right. So if you had to sell your home, you had to bring money to the table to compensate for the loan that you owed, or you did a short sale, or you let it go to foreclosure. That's the things that happened in the past. Well, obviously, as the recovery has taken place, over the many months and years that's happened, that 14 million has gone down a sliding scale and become less and less, hovering around the 5.2 million mark, which is still quite substantial. That there's basically 5.2 million loans that are still severely underwater, in today's marketplace. So it shows that recovery can happen, and there's pockets of non-recovery that still are problematic out there. But my point, though, is that There's always been a significant decrease every month. Well, last month was I guess reported that it was the smallest decrease in the amount of underwater mortgages. So clearly, as you would think, as the properties are appraising, we're hitting record volume of value. Remember, we're 7.8%, on the Case-Shiller index as opposed to 2006's peak. So there's, we've gained across the board, and I guess you could say, but so that's great. But on the flip side, when we're looking at the situation where you have the fact that those mortgages, like the underwater mortgages, are not decreasing at the same pace, that's because homeowners are back into their homes and they're stripping out equity. So how that works is the fact that you go in, you refi, you pull cash out, or you take a home equity line of credit, you pull cash out. Now your mortgage balances are increasing, which means you're less liquid on your home, but also that reflects in the underwater mortgage I guess count, and therefore less of those homes fall. Put it this way, more of those homes are now in that underwater mortgage scenario, I guess you could say. So ultimately, in the end, when equity and values are up, we as a society go back and strip it out. That's kind of our situation here. So just keep that in mind. So there's a lot of these things happening here. You got subprime reemergence, the non-banks, low down payments, all these other funky loans that have happened over the past few years, and the fact that the American public is back, I guess, stripping equity out of their homes because they need to or they want to, and then we all know from the last issue that all those money that was stripped out of the homes in equity did not go back into the homes as improvements, etc. It went for life, cars, boats, whatever it was, spending, big screen TVs. I don't know what it was, but a lot of that money was stripped out and never repatriated back into the property. So that's kind of situation we have with lending. So a lot of things going on, and this is just one of the many reasons, or I guess you could say one of the many signs that indicate what is happening right now in the marketplace virtually mirrors what happened over a decade ago. And we, as real estate investors, should be cognizant of that and prepare for the oncoming market shift and be positioned to take advantage of that, because this is going to be a cycle. It's going to happen every so often. So anyway, appreciate your time, and look forward to talking to you in the next video.